Keeping an eye on the cost of your investments and minimizing them wherever possible is vital to maximizing your total returns over the long term. After all, the less you pay in fees, the more you get to keep yourself. Just like how the magic of compounding investment returns can propel your portfolio over the long term, fees can compound too, because for every £1 you pay in fees, that's £1 less that is available to compound for you. I'll use many examples throughout this video, but let's just set the scene with a very basic illustration of the harm that costs can cause by comparing the performance of two identical £10,000 investments with £500 monthly contributions for 30 years and an average annual return of 8% before fees. The only difference is that one has a 0.1% ongoing charge and the other has a 0.6% ongoing charge. The results are pretty shocking. An end portfolio balance of £836,371 for the lower cost investment and £751,835 for the higher fee one. So about an £85,000 difference. So whilst an investor may not notice a difference each year, over the long term, a higher ongoing charge can lead to a significant reduction in the end portfolio balance. £85,000 could certainly pay for quite a few extra holidays in retirement, to say the least. Therefore, it's clearly important to minimise ongoing charges. And thankfully, more recently through the increased availability and popularity of ETFs, it has become easier for investors to access a range of low-fee products. And when it comes to the costs associated with investing in ETFs, the one that people always refer to is the total expense ratio, or TER for short. And there are so many videos made looking at the lowest cost ETFs, where this TER is the only cost referred to. However, this is only part of the cost of investing in ETFs. And surprisingly, some ETFs with low TERs may actually work out to be more expensive to invest in when all costs are considered. Importantly, lowest TER does not always equal best returns. So in this video, I thought I'd go over all the costs an investor should consider when choosing an ETF. Some of these are hidden and very difficult for an investor to come across. I'll break down the costs into two main categories. Firstly, I'll cover transaction costs, and I'll then go over ongoing charges by covering what the TER figure includes and what it doesn't include. And then finally, I'll go over how we can get an idea of the total ongoing cost of an ETF by looking at the tracking error, before summing up the total cost of ownership. Before I begin, always remember that these videos are not financial advice or recommendation to invest in any of the funds featured. Please do your own research, I'm not a financial advisor, and always remember that when investing, your capital is at risk. Okay, so let's get started with transaction costs, which are all the fees associated with buying and selling shares of ETFs. We can split this section into two main segments: fees that are specific to your broker, and fees that apply to ETF transactions regardless of which platform you use. Firstly, the main broker-specific transaction cost is the dealing fee that they charge. This could also be referred to as commission on trades, and it's just the fee that your platform takes whenever you carry out a transaction. Now this can vary significantly, and you really do need to be careful with this one, especially if you're only investing relatively small amounts of money. For example, Hargreaves Lansdown in their stocks and shares ISA charge a dealing fee of £11.95. It does scale down a little bit if you're making more than 10 trades per month, but really what sort of long-term investor is making that many deals every month? Probably not many. Where this becomes a huge problem though, is when you're only making relatively small contributions. Imagine if you wanted to top up one of your positions by £100. It would cost you nearly 12% of that contribution just in dealing fees, which is absolutely ridiculous. And heaven forbid you have a few ETFs in your portfolio and want to split that £100 between 3 of them, that would be 36% of your investment gone just in HL dealing fees. To be fair to HL though, there is a way around this, and if you only top up via direct debit, then you will not have to pay the dealing fee. But that does mean you have no flexibility as to when you contribute and you're tied into that regular schedule. On the other hand, newer platforms like InvestEngine and Trading212 charge 0 commission on trades. So you're free to make as many changes to your portfolio as you'd like and have as many ETFs in your portfolio as you want without worrying about those broker fees taking away a heavy chunk of your returns. This is especially important for beginner investors and those making regular contributions. But even those with larger sums to invest should not underestimate the impact that constant dealing charges will have on their long-term returns. However, it is up to you to decide which broker you want to use, and I actually have an investment account spreadsheet that allows you to compare a load of different stocks and shares ISA providers all in one place. Therefore, you can make sure that your current broker is not ripping you off and taking an unfair cut of every contribution you make to your ETFs. If you'd like to access the spreadsheet yourself, all you have to do is sign up to my newsletter via the link in the description. Don't worry, I won't spam you, and you're free to unsubscribe at any time. Okay, so that's the dealing fees, but there's also another broker-specific fee that you need to be careful of when making transactions of ETF shares, and that is foreign exchange fees, or FX fees for short. Now, you only have to pay this fee when you're buying or selling an ETF that trades in a different currency. For example, one that I'm investing in at the moment is the SPDR MSCI USA Small Cap Value Weighted ETF, and that does not have a version that trades in GBP, so I've been having to buy the USD one. As I invest into it on Trading 212, this fee is not too bad and it is only 0.15%, which is the most competitive FX fee I've seen for investment platforms in the UK. To compare, I'll pick on Hargreaves Lansdown again, which charges a horrendous 1% FX fee on the first £5,000 of a trade. Definitely something you want to avoid paying wherever possible. Just like with the dealing charges, you can use my spreadsheet to compare a range of different platforms. But the key thing here is that most of the time there is no reason to ever have to pay a broker FX fee. And that is because if you just stick to ETFs that trade in GBP, then of course no FX fees will apply. Nearly every single ETF you could ever want to invest in will have a GBP listed version. And the only time when I've been left with no choice has been when it came to the relatively uncommon investment of the USA Small Cap Value ETF. For example, if I search Vanguard S&P 500 on Trading 212, I can see versions listed in euros, dollars, Swiss francs, and of course, Great British pounds. If I stick to those GBP listed ones, then Trading 212 or whatever UK platform I use will not charge me any FX fees. So that's the platform specific transaction fees, but I'll now move on to the transaction fees that are part and parcel of investing in ETFs regardless of which platform you use. And the first one I'll go through is bid-offer spread, which can also be referred to as bid-ask spread. If you've ever wondered why you're immediately down after buying a share, then this hidden cost is probably why. This is simply the difference between the price at which you can buy a share and the price at which you can sell it. There's a difference between the prices because this is how the people who ensure there is a market for the shares, known as the market makers, make money. And as Vanguard put it, there are three broad factors that can influence the bid-offer spread. Volume or turnover, so basically how often the shares change hands, the volatility of the underlying securities, and the liquidity of the underlying securities. Resultingly, this means that the bid-offer spread for popular ETFs with large fund sizes and highly liquid underlying holdings is usually minuscule. But on the other hand, some ETFs can have terrible bid-offer spreads that can set you back a fair amount right from the start. A lot of investment platforms do not actually show you this spread, so it's always good to check the London Stock Exchange website directly before buying to get a good idea of what the current spread is. To illustrate, I'll now run through a few examples. First up, the Vanguard S&P 500 with the ticker VUSA. So this ETF is extremely popular, has a large fund size, and the underlying securities are extremely liquid. Resultingly, the difference between the bid and offer prices is only 2p or 0.024%. You can see how, with an ETF like this one, investors will probably not even notice the spread. Next up, the WisdomTree UK Quality Dividend Growth ETF, with the ticker UGRW. So this ETF has been out for less than a year, and the fund size is quite small. But the underlying securities are quite liquid, as it is mainly large to mid-cap UK listed companies. The difference between the prices is 12p or 0.4%. So in this case, you can see how the bid-offer spread is starting to become a bit more of a noticeable cost. And finally, for an example of an ETF with a pretty bad bid-offer spread, I'll look at the WisdomTree Emerging Markets Small Cap ETF. This is not a very big ETF in terms of fund size, but also as it consists of emerging market small cap companies, the underlying holdings are not very liquid. The difference here is 12.5p or 0.79%. In this case, an investor is almost certainly going to notice that they're not far off being 1% down just after purchasing. From these examples, it's pretty clear that bid-offer spread should not be ignored and can be a significant transaction cost for some ETFs. If you're making too many trades in and out of ETFs with high spreads, you could be losing a lot of money to this hidden cost. Okay, the final transaction fee I want to mention is actually one that we don't have to pay when investing in ETFs, which is quite a big positive, and that is stamp duty. For most UK listed shares, we have to pay a tax of 0.5% on the transaction, which I personally find quite ridiculous, and if the UK government really wanted to stimulate the LSE, then abolishing this tax would be a pretty good place to start. However, the good thing is that this stamp duty is not payable on overseas domiciled ETFs. And pretty much every ETF you'll come across that is listed on the London Stock Exchange, with a few exceptions, will be domiciled in either Ireland or Luxembourg, which means that no stamp duty has to be paid. This is a great benefit of investing in ETFs over most UK listed investment trusts and individual stocks, for example, where the 0.5% stamp duty would be applicable. So that's all the transaction costs I can think of, and hopefully you can see how, even without stamp duty, there are a number of things you need to consider. If you're buying a pretty illiquid ETF that trades in a foreign currency and on a high cost platform like Hargreaves Lansdown, you could find yourself already down quite a bit in fees each time you make a contribution. On the other hand, if you're buying a highly liquid ETF that trades in GBP on a low cost platform like Trading 212, these transaction costs will be minimal. Let's now move on to the ongoing charges, and this refers to all the fees you pay whilst actually holding the shares in your portfolio. And again, I'm going to split this into two main sections: fees specific to the investment broker you use, and fees that are part and parcel of the ETFs themselves. So firstly, the main broker ongoing charge has a few names. It can be referred to as the account fee, the platform fee, or the custody fee. But basically, they all mean the same thing. It's the ongoing cost of actually holding investments on that broker. It could be a flat fee, or it could be a percentage fee. This cost can vary greatly, so you need to pick wisely. For the more established traditional brokers, if you have a large portfolio, it's best to make sure you're using one that has some sort of fee cap. For example, despite Hargreaves Lansdown's reputation as high fee, their stocks and shares ISA account fee for holding ETFs is not actually that bad. It's 0.45%, but it caps out at £3.75 per month. So if you have a large portfolio, you probably would not even notice this fee. However, again, for the absolute cheapest option, you want to be looking at newer platforms such as Trading 212 and Invest Engine, as they both currently have zero account fees for their DIY stocks and shares ISAs. Just like with the dealing and FX fees, you can compare account fees yourself using my best investment account spreadsheet. Link in the description. Always do your own research as well and thoroughly check the website for any broker you wish to use, and make sure they're not being cheeky and charging any hidden extra fees. Okay, now on to the ongoing costs of the actual ETFs themselves. When it comes to this, the one that people always refer to, as I said in the introduction, is the total expense ratio, which is the headline charge that you will see when looking into all ETFs. Platforms like Invest Engine clearly show the TER for every ETF, and any good platform should display it. But if not, you'll definitely find the TER on the ETF fact sheet or the key investor information document that will be available to download on the fund page. A key thing to keep in mind is that you never know you've paid the TER because it is just deducted pro rata from the fund on a daily basis. In this sense, the performance you see is with the fees already taken. But what does the TER actually include? And is it an accurate reflection of the total ongoing charges? Well, the short answer is no, but let's take a closer look. The TER gives an estimated figure for the ongoing cost of owning an ETF, and its definition has been agreed between the investment industry and the European Union. It includes the following: management fees, which are the management and operating costs incurred by the ETF provider. This should be a pretty cheap component for passive index tracking ETFs like the Vanguard S&P 500, as not much management is needed. Whereas this part will make up a significant portion of the charge for ETFs like Cathie Wood's ARK Innovation ETF. The next thing that makes up the TER is custodian fees, which refers to the cost of holding the underlying securities in a separate custody account, license fees, which are paid to the provider of the index that the ETF tracks. So this is usually popular providers such as FTSE Russell, MSCI, and S&P Global, but occasionally you'll also come across ETFs that track indexes by solo active. What I've noticed is that ETFs tracking solo active indexes do tend to have lower total expense ratios, so I'm going to guess that solo active charge a lower license fee. For example, a Monday Prime Global tracks a solo active index and has a TER of just 0.05%. And then finally, the last part of the TER, distribution fees. This refers to the costs incurred for the marketing and distribution of the product, so things like the key investor information document and the fact sheets. So that's what the TER includes, but there's also a number of things it does not include. And one such cost is swap fees. Not all ETFs physically replicate the returns of an index by buying and holding the underlying securities. Some synthetically replicate the index, and they do this through a swap agreement with a counterparty. Through this agreement, the swap counterparty will agree to provide the returns of an index, including all dividend payments, in return for a swap fee and the return of the securities in a collateral portfolio. This is not a video going into detail all about swap-based ETFs, but the important thing here is that this swap fee is another cost that has to be considered. Importantly, many synthetically replicating ETFs will have lower total expense ratios and at first glance appear cheaper than the other options. To find out if an ETF uses a swap, you can check the Key Investor Information document or the fact sheet, or use a website like JustETF. One such example of a swap-based ETF is the Invesco S&P 500 ETF with the ticker SPXP and a total expense ratio of 0.05%. However, if we take a look at the fact sheet, we can also see that there is a swap fee of 0.04%. So whilst it may have a lower TER than other options, the total cost incurred may be greater. I'll return to swap-based ETFs shortly, but the next cost to consider that is not included in the TER are the costs of transactions within the ETF itself. What we sometimes forget is that physically replicating ETFs actually have to buy and sell their underlying holdings to obtain the return of the index, and depending on how often they rebalance, this can be quite frequent. Active funds will have even higher internal transaction costs, because they usually make more changes and thus have more transactions. Each time an internal transaction occurs, the bid-offer spread of the stock in question will apply. Just like how you pay the bid-offer spread when buying shares of an ETF or buying individual shares yourself. Just because you can't see it does not mean it isn't happening in the background. And finally, the last hidden internal cost of an ETF to consider is withholding tax. This is the tax paid on dividends received from the underlying securities. This is not a tax you have to worry about paying yourself, as it has already been paid at the fund level. The important thing here is that the withholding tax varies depending on where the fund is domiciled. For example, funds domiciled in Ireland only have to pay 15% withholding tax on US stock dividends, whereas Luxembourg domiciled ETFs have to pay 30%. So in general, it is considered better to stick to ETFs that are domiciled in Ireland. You can check the fund domicile of an ETF on the website JustETF by going to the Basic Details tab, but it should also be made clear in the official fund documents. For example, Amundi Prime Global is the cheapest developed markets ETF in terms of total expense ratio, with it coming in at 0.05%. However, we can also see here that it is domiciled in Luxembourg, which means that the withholding tax of 30% on US stock dividends will apply. However, it is worth mentioning that US stocks in general do tend to pay out less dividends than stocks from other countries, so maybe the impact of the increased withholding tax does not actually completely remove the benefit of the lower total expense ratio. For example, if we compare Amundi Prime Global to the Vanguard FTSE Developed World ETF, which is domiciled in Ireland and has a TER of 0.12%, we can see that on a maximum performance chart, Amundi Prime Global has still outperformed, even in despite of being subject to the higher withholding tax. Of course, they don't track the exact same index, but they both track very similar market cap weighted developed markets indexes. The final thing to mention in regards to withholding taxes is that synthetic ETFs, because they do not actually hold the underlying securities, are not subject to any withholding tax. So this is one big advantage of synthetic swap-based ETFs. If you're happy with the additional counterparty risk that a synthetic ETF takes on, then they're probably worth looking into, as they're likely to provide ever so slightly better returns due to this absence of withholding tax. For example, if we compare the synthetic S&P 500 ETF SPXP to the physically replicating one, VUAG, we can see that the former has provided ever so slightly better returns at 107.04%. This is almost certainly due to that lack of withholding tax. So that's a lot of hidden ongoing costs to consider beyond just the headline total expense ratio. However, there is actually a hidden source of income for ETFs as well. A lot of ETFs lend out their underlying holdings, and this in turn can generate income for the fund. For example, the popular iShares Core MSCI World ETF, ticker SWTA, states on its webpage that it has an annual return generated from securities lending of 0.03%. Now, I know that's not a lot, but I just wanted to quickly mention it because it's extra income nonetheless that may help offset some of the costs. Now that I've gone through all those ongoing charges and potential source of income though, it's now worth considering how we actually work out the net impact of those costs if the TER is not an accurate reflection. Well, the first thing to remember is that the performance of an ETF you see is with all the fees already taken, because they're deducted at the fund level. Once you see that return in your investment account, that is with all those ongoing charges already taken. This is why you can fairly compare ETFs using the charts on websites like JustETF. However, in terms of seeing the net impact of costs on an individual ETF, you can look at something called the tracking error. This is the difference between the return that the ETF provides and the returns of the index it tracks. Sometimes the return of the ETF can actually exceed the returns of the index, due to the security lending income, or because the ETF holdings slightly differ, or a couple other reasons, but it isn't often the case. More often than not, the ETF will deliver a slightly lower return than the index it tracks, due to the impact of costs. You can usually find the tracking error on the ETF provider website by taking away the return of the benchmark index from the return of the ETF. For example, on the WisdomTree website for their Global Quality Dividend Growth ETF, I can work out that the tracking error for 2023 was 0.23 percentage points, which is interestingly lower than the total expense ratio of 0.38% for this ETF. It's always worth checking the tracking error because you may be pleasantly surprised by how well some ETFs track their indexes, even despite of their relatively high total expense ratios. I've gone through a lot in this video, but I thought a perfect way to end it would be on this graphic by Just ETF, which covers most of what I've discussed in this video. I hope this really highlights how the total expense ratio is just one piece of the puzzle, and there are so many different costs to consider and take into account when working out the actual cost of buying and owning ETFs. As I always say in a lot of my videos though, try not to obsess over fees and consider all aspects of an ETF before investing. The tracking difference will give you a good idea of how the ETF performs in comparison to the index, but also be open to the idea that some ETFs may well be worth the slightly higher fee. An example of this for me is UC99 compared to VUSA. UC99 may have a higher total expense ratio and a slightly worse bid offer spread, but in my opinion, it has been worth paying those higher costs due to the benefit of the quality factor and the return premium it has delivered over VUSA. Of course, past performance does not guarantee future results, but it's just one example of why sometimes it may be worth paying higher fees. Anyway, that is it for this video. Let me know what you think in the comments below, and if you're looking for something else to watch, check out these videos on screen now. As always, thank you for watching.